evening. In what comes as a setback for online retail platforms like Flipkart and Amazon, the government has tightened the norms for e-commerce companies with foreign direct investment. The revised policy makes it tougher for such e-commerce platforms to offer heavy discounts or hold exclusivity on products. Now, these players also have been barred from selling products of businesses in which they have a stake or enjoy control over the inventory. Rituparna Bhuya now joins us to give us more clarity. Ritu, clearly, no questions asked. This is a tightening of sorts as far as the government is concerned, as far as the e-commerce firm is concerned. Can you describe the impact for the benefit of our viewers? Ritu.
Well, this means that, the products which one could exclusively buy from a e-commerce portal, and this was a successful marketing strategy which was used by almost all e-commerce platforms, that won't be allowed from now on, which means that any product cannot be sold exclusively by a foreign-funded e-commerce platform. That is one. Secondly, what we saw in the fine print is the expansion of the level playing field norms. These new norms now say that all buyers in such platforms will have to have access to logistics, warehousing, advertisement, marketing, payments, financing, etc. One or two or a set of buyers cannot be given priority by the e-commerce player while marketing products. All buyers in a platform will have to be treated equally. Not only that, even as far as cashback by group companies of e-commerce portals, they will have that has to be done in a fair and non-discriminatory manner. This is what the new FDI norms on e-commerce say. Last but not the least, if a e-commerce portal holds equity in a company which sells products through its portal, then earlier it was allowed, but the new norms say that any company which has equity participation from a foreign-funded e-commerce player will not be able to sell products from such a seller. So these are the three important norms that I saw. Last but not the least, these norms will be applicable from 1st of February 2019, and every year by 30th of September, RBI will have to be given a compliance certificate by these e-commerce companies every year regarding the compliance of these norms, which was released today.
Right, everything. Discuss this very same issue. We're now joined by Ashwani Mahajan, the co-convener of Swadeshi Jagran Manch, PwC's Akash Gupta, as well as Praveen Khandelwal, Secretary General of CAIT. Mr. Gupta, let me come to you first. At a time when we have been rallying about the big investments that we're seeing on account of Walmart being interested in the Indian market, what does such a tightening of rules perhaps suggest? We've seen that the conditions that have been levied, there's a significant amount of tightening. On the legislative side, there appears to have been some thinking in terms of how to perhaps tighten the regulations for the e-commerce players. What are your takeaways from an industry perspective? Mr. Gupta.
Yep. So there are two kinds of clampdowns which have come in. One is in relation to the way group companies, if any of the marketplace entities, the restrictions being imposed on their trade on the marketplace. Even the traders who deal with such group companies have been put under some kind of restrictions. Fairly restrictive prescription here. If you look at historically in 2009, when the government came on the wholesale trading guidelines, even there, the wholesale traders were allowed to deal with group companies up to 25% of their turnover. And the same principle was followed in the earlier Press Note 3, where up to 25% of the turnover could be maintained when you are dealing in an e-commerce platform. In the current amendment, there's that 25% window has completely been taken away. That means any group company of the e-commerce player cannot trade on that platform. So that's a significantly restricted step. So that's one, which can have impact on FDI on some of the companies coming in. So they would need to have a relook at their structures and see how it becomes compatible with these regulations. The other set of restrictions are more to bring some kind of fair and non-discriminatory approach towards the marketplace in terms of dealing with the various vendors. That would be more operational and would require some policy changes to align with the regulations.
That again appears to be the consensus, that there is a certain amount of tightening involved which could perhaps potentially impact the FDI that's coming in. Let's also get Mr. Mahajan in on the conversation. So your first thoughts, there appears to be a clear tightening, and the bias of the tightening appears to be in favor of ensuring that there is no, let's say, incestuous behavior by the e-commerce companies, that they do not hire or they do not sell or they do not sell goods from a company that they have stake in, which is a clear allegation that has been made against them in the past. What is the message that you're taking away as a part of this tightening of norms by the government? Mr. Mahajan.
In fact, what the new policy is suggesting was actually there in Press Note 3 when they were not supposed to give any price distorting discounts. And this is just to make it more clear. This policy is making it more clear. And the fact that these companies were actually circumventing the law when it was very clearly written in the Press Note 3 that you cannot offer price distorting discounts. So in this case, when this press note is coming, this is now putting further restrictions on these people because they were circumventing the law by B2B route. And
Mahajan's thoughts on that. Mr. Mahajan, the same question, Mr. Khandelwal, I beg your pardon, the same question that we had posed, that the bias in this tightening appears to be to ensure that there is no incestuous behavior by the e-commerce companies, that agencies that are controlled by them, agencies where they have equity, are not the very same agencies that are selling goods on the same marketplace. Is this, in a manner of speaking, perhaps a vindication of your position? We've already received a comment from the CAIT. They've welcomed it. Mr. Khandelwal, your thoughts?
Yes, it is a welcome move. And the clarificatory note which has been issued by the government today clearly spells out the policy of the government that exclusivity, preferential treatment, predatory pricing, deep discounting and loss funding will not be allowed any further. And we all know that these companies, whether it is a multinational company in hand in glove with marketplace models, they were adopting all these kinds of policies to kill the retailers, and their ultimate goal was to control and dominate the retail trade of the country. Well, at this point of time, the government has taken a call which was long awaited. And so certainly now these companies will not be able to play their dirty game of exclusivity and preferential treatment at least. And therefore,
let's avoid name calling. Let's avoid name calling here. Let's avoid name calling. Let me just quickly ask you a follow-up question. Given that we are around the curve as far as the 2019 Lok Sabha elections, can I dare ask perhaps that is this a move towards assuaging the sentiments of small traders at the expense of the big FDI players? Is that a charge? Is that a question that perhaps can be raised when we're just around the curve as far as the Lok Sabha elections are concerned? Mr. Khandelwal.
We should not link it with the Lok Sabha elections, but yes, if the note is properly implemented in its letter and spirit, it will certainly give leverage to small retailers to come online trade and to adopt it in a very transparent manner. So therefore, there will be a level playing field. But my take will be that the policy has to be implemented in letter and spirit. We have seen press note number 3 has been flouted by these companies, and we made several complaints to the government, but no action was taken against them. But now,
Khandelwal.
If anybody flout the rules, then they have to face the action.
Industry Ministry via DIPP press note has also prohibited e-commerce companies from entering into agreements for the exclusive sale of products online. Now, while sources from the dominant players in the industry have decried these measures as discriminatory and as a negative in sentiment, it's very clear that these clarifications are not a reversal of the FDI e-commerce norms, but merely close off any grey areas that existed earlier. Now, while both Flipkart and Amazon have refrained from officially commenting, saying that they are still evaluating the press note that came out last evening, I'm joined today on the show by Kunals of Snapdeal to discuss the impact that this will have on their business, but more importantly, actually, just to clarify for us where things stand on some of the specifications or some of the clarity that emerged yesterday in the press note. Last night, as soon as the press note came out, that this was a welcome move. And in the context of, Snapdeal 2.4, it definitely is. But give us a wider perspective from the point of view of industry. What makes this welcome? What are some of the positives that you see within the clarifications that emerged yesterday?
Look, the FDI guideline around e-commerce has been quite clear. For the most part, as part of Press Note 3 that came out about almost 2.5, 3 years ago. However, as you rightly said, there were a lot of grey areas potentially that I guess the government felt was creating circumvention of Press Note 3. And yesterday's enhanced guideline was meant to close out any such potential grey areas that were creating circumvention of the policy. So it's good because I feel that at the end of the day, the purpose of e-commerce marketplaces is to create a platform that can connect the long tail of demand to the long tail of supply in the country and provide MSMEs the ability to reach consumers nationwide, which obviously was not, which was getting hampered because certain, related party sellers were probably crowding out the small sellers.
Correct. So on this issue of related party sellers, correct, now the clarification that has come in has said that while earlier there was a sort of 25% cap on the purchases that could be made from these entities, this note now seems to suggest that, the marketplace cannot even have, sort of any sort of equity in these related parties and players. Are we reading that correctly? How have you interpreted that particular 25% clause?
Yeah, I think they're two different things. The fact that no related parties should be allowed to sell is very clear. There is 0% sale allowed by a related party on a marketplace because otherwise there is unnecessary influence, which hurts the neutral nature that a marketplace needs to have. The 25% clause is a completely different matter. Our understanding is that the 25% clause pertains to any seller on a marketplace cannot procure more than 25% of their merchandise from a single B2B wholesale player. And the reason this has likely been introduced is because oftentimes the B2B company is a related party of the marketplace from which the downstream seller is purchasing. And what the government probably wants is to make sure that the end seller on a marketplace is not just a dummy entity that is procuring 100% of its merchandise from one wholesale party, which is a related party of the marketplace.
Would you say that in a pure marketplace model, like the one that Snapdeal has now, that there should be no single entity, whether it's related to the marketplace or not? It could be a completely third-party vendor that still cannot sell more than 25% of, how would you classify it, sales or inventory through the marketplace?
So there is no such restriction. The only restriction is that that seller on the marketplace cannot procure more than 25% of its merchandise from any one entity. That's the only restriction.
Okay.
There is no restriction, as per our understanding, on their share of sales on a marketplace. They could be selling 100% of their items on a particular marketplace, but cannot be procuring more than 25% of their items from any one company.
Because I think there have been some reports on how small vendors and SMEs might be impacted by this. And that brings me to the next point, Kunal, which is around the impact to your mind that this will have on the long tail of MSMEs and small sellers that you spoke about earlier, for which this, the marketplaces were supposed to be some sort of panacea, giving them a sort of access to a sales route that they didn't have access to earlier.
Correct. I think marketplaces are such an incredible tool, platform, channel for the smallest of seller with the smallest of resources to reach consumers across the country. Right now we have about 100 million e-commerce buyers in India. This number will go to 500 million buyers in the next 5-10 years. And even the smallest MSME in the country could tomorrow become a large national or international brand thanks to the reach the marketplaces are providing them. But that will only happen if they have a neutral level playing field, not one in which they get crowded out or they get competed against by the marketplace itself. And that's always been our view as well, that we've always felt that we shouldn't compete as a company, as a marketplace.
That's always been your view, Kunal, in Snapdeal 2.0. Would that be fair to say? That's been a view that you've taken in the last year and a half?
That's always been our view, even before that.
That the press note seeks to clarify is the issue around exclusive sales and discounting and predatory pricing. Now, what impact, if at all, do you think this will have on consumers who you can say have become used to, these kind of discounts? And an allied question to that is, on these pure play marketplaces, how would discounting work? I mean, if I'm not mistaken, I know that you had some sort of Diwali sale or discounts that are offered. What's the dynamic in this case, which is different from, what the other players, the likes of Amazon, Flipkart, etc., are doing?
Sure, that's a good question. Look, my view is that if a marketplace is offering a level playing field and is, encourages sellers of all shapes, sizes to flourish, the sellers will compete against themselves to offer the best prices to consumers. Exactly how it happens in any of the malls that we go to or any of the bazaars we go to in our country. Over there, Lajpat Nagar in Delhi is not discounting the merchandise of a seller there, or Ambience Mall in Gurgaon is not discounting the merchandise of a brand that's sold in that mall. They are merely providing a platform to those businesses, large and small.
Got it.
So invariably, market finds all products find their equilibrium pricing at which consumers find it attractive. Otherwise, the merchant goes out of business. And that's the nature of the world of business. However, the challenge that our space has been facing is that particular...
No, go ahead, Kunal, go ahead.
Sure. So what the challenge our space has been facing is that particular sellers were getting disproportionate amount of discounting funded by the marketplaces, which was creating a negative impact both for the sellers on the marketplace as well as offline retailers.
All right. So it comes back to that one question, Kunal, on how do discounts then on Snapdeal, for instance, work? How did your Diwali sale work? What is the mechanism from offering those discounts? Because I still see those happening on Paytm Mall, which claims to be pure play marketplace, Shop Clues, yourself even. How does it work? What's the dynamic and how is it different from what the other folks are doing?
It's actually no different from when you go to a market or a mall during Diwali. Different stores have discounts running and the sellers are funding the discount.
Okay.
It's actually no different. Rather than there being a physical marketplace, there's a virtual marketplace. There's no other difference.
Execution of these clarifications that have come in and of the FDI norms as well, right? I think what was lacking last time was that there were these grey areas. Also, there wasn't any sort of nodal agency that was looking at this. What makes you hopeful that this time around, there won't be loopholes found and circumvention happen? What, to your mind, are some of the things that can be incorporated, if not in this policy, not in this particular note, but, we are expecting an e-commerce policy shortly as well. What are some of the regulatory measures that can be put into these policies to make sure that there is no circumvention?
The very fact that the government has come up with a top-up guideline shows the intent to enforce. And I hope that there is an intent to enforce on a going forward basis. So that we don't have the situation we had post Press Note 3, where the guideline was well thought out. However, there was no enforcement that happened after that, which has precipitated the creation of a follow-up guideline. But I do believe that there must be genuine intent, and otherwise, why come up with a top-up policy at all?
Is reporting to RBI before the, reporting to RBI before the 30th of September of every year enough enforcement? Enough sort of intervention, or would you like to see more, and what would the nature of that intervention be?
Look, we have to remember at the end of the day, we're all startups and have our own challenges and dynamics and complexities of running a business day to day. There are certain rules and guidelines the government has set. There is generally a self-regulation every company should have, that these are the rules of the land and they should be followed. But we shouldn't overwhelm all the companies with excessive regulation to the point where they can't even run their businesses day to day. So there's always a fine line that shouldn't be crossed. I presume the government will probably be in watch mode in 2019, see how the guidelines play out, how the adherence to guidelines and enforcement of guidelines plays out. And maybe they would revisit in a year's time, is my sense.
All right.
To your question about, I think you asked a question about what else would you want to see. I would say, no single seller should contribute to more than 1 to 5% of a sales of a platform, because that ensures, again, that there is enough diversity of traffic available to sellers.
See the impact of this on the larger e-commerce business, right? I mean, we saw, the Flipkart, Walmart deal. We know that Amazon has committed a lot of money, upwards of $5 billion to India. They continue to invest. They continue to forge partnerships. What is the shakeout that you see going forward? I know it's, you might want to take the line if you don't want to comment on other businesses, but for the industry, what would you reflect on what might actually happen? Because this might be seen as investors as a dampener, if nothing else.
I don't know about that. I think the investment that has been coming into this space through a variety of companies, including our own, is great for our country. It's helped to build consumer awareness. It's helped to nurture a new base of sellers, MSMEs, who are selling online and creating businesses. It's helped to create logistics infrastructure. So there's a lot of good as a result of all the investment that has come in over the last 10 years through all the companies, us included and every other market player included. So I think we should not go into a zone of doom and gloom. Oftentimes markets go through a regulatory correction, which in the long run is likely good for the market and all its players.
Segment, Sanjay Sethi of Shop Clues and Akash Gupta.